Now we need to talk about long-term liabilities, and I think we know the definition of this. We know the definition of liabilities, and long-term would be those that are not going to be due within the next year. There are three major ones we're going to be talking about: notes payable. And so long-term notes payable are just like the short-term notes payable, only the time period has changed. We have deferred income taxes, and then we have bonds payable. And corporations typically issue bonds payable. Instead of a long-term note, they will issue bonds. And bonds will be issued in what we call a bond market, which is very similar to the stock market. So there are many different sources of funds for a corporation versus other companies. And we call these bonds financial instruments. So in a bond, you're going to have the maturity date, and this is the date at which the amount of the bond will have to be paid. And what's going to be paid is the face value. And it's called face value because it's written directly on this bond document. So see, it says up here, US $1,000. This is the amount that's going to have to be paid, and it's a legal document. The legal document is dated, and it states the date at which it's going to be due. There's also an interest amount. This is called the stated interest rate, which is the interest rate which this is going to be paid. So a stated interest rate is going to be, again, annual rate, and the annual rate on this is going to be multiplied by the face value to get the amount of cash interest that's going to be paid. So from what you know about notes, this is going to help you in understanding how a bond is handled. You can think of it then as a note, but it's a note that's done with a large corporation because there's a market for it. Another difference to think about here is that there's going to be a stated interest rate, and there's going to be a market interest rate. And there's also going to be another amount that's the value of the note, or value of the bond, pardon me. And in the bond market, the bond values will go up and down depending on interest rate changes, and because of this, you have to say that the market value of a bond and the face value differ. The interest rate calculation is going to be a familiar one to you. It's going to be simply then the face value times the interest rate, which is an annual rate, times the number of months that have passed. And so you would accrue interest on bonds just like you have accrued interest on the notes. You look at how far along we are in the financial statement period, and you'd count the months and you re-record that interest payable. The bond price, though, is something that's a little more complicated, and I'm not going to get into it this semester with you, but I just want you to understand, as I said just a moment ago, that the face value and the market price is different. If the bonds market has a higher value on it than face value, we call this a premium, and this actually gets recorded when we issue the bond or when we get the cash in. And so when we get the cash in from selling a bond, the cash in would be 107,260 in this case. If we get more in than the bond's face value, which is 100,000, we call it a premium, and we record it in an account called premium on bonds. If the amount of cash we get in is exactly the same as the face value, there's no discount or no premium. If we get less in than the amount we're going to have to pay in the future, which really does kind of sound bad, doesn't it? Then that's recorded as a discount on bonds payable. These accounts, think of them as something like contra accounts. except you'll notice probably that the premium account is going to have a credit balance and the discount is going to have a debit balance. So it's not exactly a contra account, because in contra accounts the balance is the opposite direction of the main account, and that's not the case with premiums. We call a combination of bonds payable and premium, or bonds payable and discount, because this particular bond cannot have both a premium and a discount. It's going to be one or the other, or maybe none in the case of it being sold at its face value. Well, this is called carrying value. And why we have premiums and why we have discounts, all I'm going to say right now is that it has to do with interest rates. So I'm not particularly interested in you understanding all of this. If you're an accounting major and you're going to take intermediate accounting, you're going to get this again. If you're going to take your finance class, your introductory finance class, you'll get it in that class as well. So I really just want you to understand that if bonds are sold in the marketplace and we sell those bonds and we get cash in and we get more than we're going to have to pay in the future, then that's a premium. If we get less, it's a discount. And if we get the same amount as the face value, there's no premium, no discount. Here, General Mills receives 100,000 in cash in exchange for 100 bonds at their face value. No premium, no discount. Then we get 100,000 in. How do we record this? Well, it's cash in, a debit, and bonds payable. Now, if we got in more, then we are going to record the bond payable is going to stay at its face value, and we'll record the difference in this thing called premium. And it's a premium because we got more than the face value. If by chance we got less than face value, or 93,376, then this is called a discount, and we're going to still put the liability on at its face value, which is what we're going to have to pay in the future, but we're going to record a discount, and the discount is going to make up the difference between the cash we got in and the bond payable at maturity. We record this as a discount. Notice that they're using this calculation, or they're using the common notation here for a contra account. In this case, it looks like a contra because to create the bond, we credit it, and to record the contra, to create the contra account, we debited it. So yeah, it looks like a contra. It acts like a contra in this one, whereas in the other one where we received, I think it was over 107,000, we had a premium, and the premium was a credit, and there were two credits. Didn't really look like a contra in that case. Now, if we have interest, we are going to calculate the interest again, and we're going to look at the number of months that have passed. So if we were to do our financial statements after just 1 month, technically we should be recording our interest expense and interest payable for that 1 month. And that is going to be calculated as the amount for that 1 month of $500. Interest expense, interest payable. Now I'm going a little fast through this because I know you have just seen this. You saw this on notes on the note payable, where we had a note payable and we had to calculate it, and it was on that one we were calculating 2 months. In this we're just calculating 1 month and recording it, but it's the same concept. Now, if we go through and we retire these bonds, we are getting rid of the bonds and retiring the bonds. We are going to pay $100,000 to pay off our bonds. Well, we take the bonds off our books. If there's no premium or no discount, we just take the bonds off the books. If we had a premium or we had a discount account, we would need to remove the discount and remove the premium. So if we have an early retirement of bonds, we're going to pay cash, whatever we need to do to get rid of the bonds. We're going to take off the bond liability, and any difference will be either a gain or a loss. And as I said before, you need to remove any premiums or any discounts associated with that bond when you do this. So, here we have General Mills. They issued their bonds at face value, which tells us there's no premium and there's no discount, because they issued them at the same amount that they're going to have to pay back, which is the $100,000. Okay, but to get them off the books early, it says retire the bonds early, we're going to pay an additional amount. Okay, now I want you to see here that there is an error here with this, because in here they say the cash payment was $103,000, and up here they say the payment was $102,000. So let's just take it forward and see how we can correct it. Alright, so it is indeed a payment of $102,000. When we pay the $102,000, that's the credit to cash, because that's our payment. The bond is on the books and gets removed for the $100,000. The difference is a loss on bond retirement. Now the corollary to this. What is the corollary to this? Just in the previous chapter, we had equipment, and we got rid of equipment. And we said the way you look at it is you get rid of the equipment, you take it off the books, you take any associated accounts that are associated with that equipment off your books, which is accumulated depreciation, and then you record the cash amount and you do what you need to make it balance. The same thing is happening here. With equipment, we either had a gain or a loss, or maybe even Steven, nothing done, right? No loss, no gain, or no loss. If we didn't need anything to make it balance, there was no gain or loss. In this case, we're paying $102,000, that's our credit. We have the bonds, only one bond account, no premium, no discount, only bonds payable of $100,000. So because the credit is $102, the debit is $100, we need another $2. And the same rule about gains and losses applies here. If we need a debit, it's a loss. If we need a credit, it's a gain. In this case, we needed a debit, so it's a loss.